board, Ashish, CIO Axis Mutual Fund, to talk to us about what he's viewing with regard to markets. Ashish, a very good morning to you. Let me first try and contextualize it from a macro perspective. You could have a trade deal in place before March, at least the chief economist seeming positive with regard, or chief economic advisor seeming positive with regard to that. The second piece is, of course, rate cuts in the US. That's happened, 25 bips. Your take with regard to what happens going forward, but a $40 billion stimulus, or I may not call it stimulus, I ought to call it liquidity push, and what that does to Indian markets and Asian markets. Your view.
Good morning. Thanks for having me on the show. I think the macro backdrop for us, whether you look not just in terms of the rate cuts, but really more importantly, the trend that we have had in terms of GDP growth has been positive. Right? And we started to see that reflect in both market earnings and earnings forecasts. So I think on that basis, we are continuing to see a positive trend. The challenges have been, as you highlighted, concerns about the trade deal. But I think equally important is what's happening on the currency market, right? And we have seen both the widening of the current account deficit as well as challenges on the capital account, given the lack of portfolio flows and really no pickup in net FDI. And I think that is one negative change compared to about 6 months ago that has come about, where really India's macros were bulletproof. So while earnings are kind of showing a much better trend, and we are actually very optimistic about 2026, where we see double-digit earnings growth coming back to the market, earnings growth coming back on a broad-based market. But on the macro front, I think the concern on currency has been a recent development. And if a trade deal comes through, and again, it's also important is what are the contours of the trade deal, and does India kind of get favorable terms compared to some of its competitors? Because that is really the push needed for us to get further pickup in FDI, further acceleration in exports, and that kind of will alleviate the concerns on the currency side as well.
Ashish, what are you building in terms of EPS growth? And I'll quickly shift to domestic. What are you building in terms of EPS growth, FY26 and FY27 especially? Because we're close to the fag end of the year, and very, very quickly we'll have FY27 numbers already starting to get baked in. So trying to get a sense of whether you're seeing any upside surprises to that FY27 or perhaps FY28 numbers.
Sure. So I think FY28 is a bit too far away. Sure. So, but if I talk about FY26 and 27, so FY26 now we are looking at 8 to 9% growth for market earnings. FY27 we see it picking up to about 16 odd %. And while we are not seeing upside to these estimates, but if you see last 5 quarters, the past 5 quarters, we had actually seen after every quarter market earnings getting downgraded. And this is really the first quarter, the second quarter was the first quarter when we did not see major downgrade in market earnings after the result. So I think we are seeing really the earnings downgrade cycle kind of reverse. And in fact, FY27, if I look at the forecast across multiple sectors, there is double-digit growth expected. So if you look at automobiles, you look at cement, you look at financial sector, virtually every sector there is a pickup expected. And therefore, I think the risk to the earnings estimate of 15-16% is relatively low because it is very broad-based.
Right. Ashish, what's the view though on where the earnings revival would first come in? While of course Q2 has been largely in line with what the street was anticipating, but
Yeah.
where or within which pockets do you see meaningful earnings upgrades kick in next?
So I think earnings acceleration is visible across sectors, right? So I think everyone is baking in better earnings coming through, as I said, across multiple sectors. Whether you look at NBFCs, you look at banks, there's pickup in credit growth. The margin compression is really behind us. In some NBFCs, you are also going to see relative
Hmm. Uh,
relatively lower credit costs. If you look, for example, the automobile sector, while the passenger vehicle players were doing okay, now this year we have seen recovery in two-wheeler players, and now we are seeing early signs of even the commercial vehicles cycle reviving. So I think you are seeing multiple sectors where there is earnings acceleration that is going to through. Of course, one sector where the earnings outlook continues to be more moderate is really the IT services sector. So there, we don't have visibility of any meaningful upgrades. Maybe there will be some positivity because of the currency, but really in terms of constant currency revenue growth, there's no major acceleration expected.
Ashish, and within sectors, we have seen sector rotation at least over the last year, despite markets largely being flat. What sectors do you believe look poised for uptick in terms of risk reward? What's looking attractive to you?
So I think we are seeing very, and I can talk about where we are positioned. So we are positioned on the automobile sector. We are positioned in financial sector. One place we have increased weight is really on the consumption side and consumer discretionary in particular. Uh, Internet plays are also kind of seeing it. They can be in consumer tech, fintech. Those are places they are that are seeing, I think, favorable risk reward. We have seen the EMS space that has corrected sharply over the past couple of months, now offering better risk reward because really next few years there is a big potential upside in revenue growth in this sector. We continue to be positive on power and defense despite the correction that has happened recently. And I think those are two other themes that offer good risk reward at this point of time.
Ashish, I'm curious to know what is it that you're making of the bounce in IT as a pack? Of course, coming out of a very neglected zone, but the rupee weakness also acting as a tailwind.
Yes, I think it's both rupee weakness. It is the underperformance of the sector. So I think as we have seen some correction come through in mid and small caps, I think IT has been a sort of relative safe haven. So IT and healthcare have defensive characteristics that have helped them outperform over the last couple of months.
Hmm. Okay. And uh, Ashish, if I were to uh, try and get a sense with regard to some of the export facing or global facing kind of sector, something like a metals, for example, what's the take there? Would you avoid at this point, or is it a good time to maybe add?
So I think metals and commodities more broadly, I think uh, are not moving in a pack. So we are seeing fairly different trends across ferrous and non-ferrous metals, for example. Right. So I think you'll have to be very precise in terms of which part of the commodities pack you focus on. We have seen within commodities, for example, oil continuing to trend down, while most other global commodities have found a support. I think for contrarian investors, oil, despite the weak fundamentals, as of now, may be a sector to focus on. But for us at this point of time, with metal, the focus is really on the non-ferrous side.
Okay. Great to have you then on the show today. Thank you so much, Ashish, for your time.